Let's jump right into this explainer and completely demystify the core mechanics of market structure. We're going to look closely at the hidden framework that literally dictates why trades ultimately win or lose every single day. 98%. Honestly, take a second to let that sink in. That is the widely accepted and frankly staggering percentage of traders who fail to consistently make money in the markets. It's a massive failure rate for an industry that so many people pour so much of their time and capital into.
So you really have to ask yourself, why do so many traders fail? Well, I tell you right now, it's not a lack of screen time, and it's definitely not a lack of effort. The real culprit? It's a fundamental misunderstanding of one specific, multi-layered market structure model. People are staring right at the charts, but they are completely misreading the story that's being told.
To fix that, here's exactly what we're covering in this explainer. Basic market structure, the internal structure illusion, multi-dimensional timeframes, and finally, a real-world trade strategy.
All right, kicking things off with Section 1, Basic Market Structure, the foundation of direction.
Let's establish our baseline with swing points. Think of these as your guardrails. They're those areas of sharp market reversals that set up our high and low bounds. Basically, if you can correctly map out your external swing points, you've already won half the battle. Because now, you know your true direction. You know exactly the framework you're operating inside of. Once we've got those guardrails, we're looking for a break of structure, or a BOS. This happens when the next price leg pushes right through the previous high in a bullish trend, or the previous low if we're bearish. This is absolutely crucial, because a break of structure confirms our expectation that the trend is continuing its momentum. It's the market's way of saying, yep, we're still going this way. But, trends do eventually run out of gas. And that brings us to a change of character, commonly known as a cho-cho. This is the definitive, undeniable shift from bullish price action, where we are making higher highs, over to bearish price action, where suddenly, boom, we put in a lower low. This brilliantly illustrates the exact moment an exhausted trend finally flips, completely shifting our trading expectations from buying to selling. Moving right along to Section 2, the internal structure illusion, also known as exactly where traders lose their money. So you've got your external structure, which is dictated by those macro swing highs and lows we just talked about. It defines the true trend and is incredibly reliable for your directional bias. But then, you have internal structure. This is all that messy price action trapped between your external swing points. It's super complex, it's incredibly choppy, and honestly, it's the exact trap where 98% of traders get chopped up and lose their shirts. And here's exactly how this trap springs. Traders get hyper-focused on trading this internal structure, and they constantly get faked out into believing a minor pullback is actually a brand new trend. They'll see an internal pullback, put in a lower low on the chart, immediately assume the market is suddenly bearish, smash the short button, and then get completely wiped out when the true macro bullish trend resumes and just blasts right through their stop loss.
Let's layer this up in Section 3, multi-dimensional timeframes, the parallel universes of trading.
This brings up a really fascinating question. How in the world can the market be bullish and bearish at the exact same time? I know, it sounds like a paradox, but understanding how two traders can look at the identical asset, have completely opposite biases, and somehow both be technically right, that is the absolute secret to timing your entries.
You see, a time frame is simply a single perspective of a living organism. Your 15-minute chart might be in a macro bullish trend, but currently experiencing a temporary pullback. Now, at that exact same time, if you zoom down into the 1-minute chart, that identical pullback looks like a violently aggressive, bearish micro expansion. These time frames are just showing different dimensions of the exact same reality.
So how do you actually build an edge from that? It goes like this. The 15-minute pulls back, which actively forces the 1-minute to shift bearish. Then, the 15-minute finally hits its target swing low. At that exact area, the 1-minute triggers a change of character right back to bullish. There's your edge. You buy that 1-minute shift to target the old 15-minute high. By just waiting for the 1-minute chart to snap back into alignment with the 15-minute macro trend, you get an advance warning of exactly when the pullback is over.
All right, let's put it into practice. Section 4, Real-World Trade Strategy, Executing the New York Session. We're going to deconstruct a live trade breakdown from May 1st during a New York session setup. This is an actual trade taken by professional trader Lewis Kelly, and we're looking at it so you can see how perfectly these concepts flow together in the real world. Here is our mechanical, highly repeatable checklist for the New York Open. 1. Identify the 15-minute bias. 2. Wait for a liquidity sweep. 3. Wait for a 1-minute change of character. And 4. Enter on an imbalance, like a fair value gap. Having this step-by-step framework ready is absolutely crucial the second that opening bell rings.
First things first, we zoom out to map our 15-minute external structure and identify the true swing high down to the swing low. Doing this confirms a solid bearish macro bias. We also set our target right at the London session equal lows, since we know those act like a massive magnet for liquidity. So right out of the gate, we know the 15-minute structure is aggressively bearish. That means our one and only job today is to hunt for short opportunities. We ignore all the other noise.
Now, as the session opens, price sweeps right into those London equal highs. And guys, this is where you need immense discipline. At this exact moment, the 1-minute chart looks insanely bullish as it pushes up. But you have to just sit on your hands and watch the battle between supply and demand. You absolutely do not enter just because the 1-minute looks bullish. You patiently wait for supply to win that battle and break the 1-minute low. That confirms the bearish shift and brings everything back into alignment with our 15-minute bias.
Once that 1-minute low actually breaks, boom, we have our alignment. We take our entry right at the inverted fair value gap, that market inefficiency left behind by the sudden drop. With both timeframes finally synced up bearishly, we use that imbalance for a laser-precise entry, and we place our stop loss safely above the high that would invalidate the trade. Because obviously, if price goes above that high, the 1-minute is bullish again, and we want out immediately.
And what happens when you apply this kind of patience and multidimensional alignment? You net a massive 1-to-6 risk-to-reward ratio. Literally, because we perfectly timed the micro-reversal and entered the precise second both timeframes agreed, our target down at the 15-minute swing lows yields an incredible return for the tiny amount of risk we took on.
But, hey, before you go rushing off to the charts, you've got to remember something. Mastering a structural trading strategy is really just one piece of the puzzle to actually becoming consistently profitable. As beautiful as this setup is, having a mechanical strategy mapped out on a screen doesn't automatically protect you from your own psychology, your fear, or your greed when you're in the live markets.
There's a great quote from the source material that hits the nail on the head. Our job is to understand who is the strongest force and let me trade in alignment with their direction. It's that simple. Trading really isn't about predicting the future. It's just about identifying whether supply or demand is currently winning the structural war and then firmly aligning yourself with the victor.
So, I'm going to leave you with this final thought to chew on. If you now understand the mechanics of market structure, what are the internal psychological barriers keeping you from joining that profitable 2%? Take some time to really ponder that, because mastering the chart is only half the battle of mastering the market. Keep studying, keep watching those swing points, and I'll catch you in the next explainer.